It's time for Yahoo Finance's Market Minute. Stocks edging higher as investors digest a better-than-expected inflation print and a U.S.-China trade truce for now. The data boosting rate cut hopes. Markets now pricing in a slightly higher probability of a cut in September, according to CME's FedWatch tool. Shares of quantum computing stocks surging after NVIDIA CEO Jensen Huang said the technology is facing a, quote, inflection point. Huang going on to tell a crowd at NVIDIA's GTC Paris Developers Conference that quantum could be able to solve some interesting problems in the coming years. And Lockheed Martin shares falling on news the Pentagon is cutting its order of F-35 jets in half, according to Bloomberg News. The Air Force is now asking for 24 fighter jets this year, down from 48 in 2024. Meantime, the House Appropriations Committee is just slightly boosting its order for branches of the military for fiscal year 2026. That's your Yahoo Finance Market Minute. Scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, Portfolio Check-In, we examine what one portfolio manager says is an overlooked trade on Wall Street. And our read on the latest inflation print. We'll discuss food and shelter prices with some experts. Plus, all week on Wealth, we're talking about student loan repayments. Today, we'll zero in on all of the shifts and potential changes in the student loan space under the Trump administration. All that and much more coming your way this hour. But first, let's take a look at some of the market action. We're 90 minutes into the trading day and stocks rising after the May CPI report shows inflation rising at a slower pace here. My next guest says that mid-caps are overlooked by Wall Street, making them fertile grounds for active stock pickers. Joining me now, we've got Amy Zhang, who is the Alger Executive Vice President and Portfolio Manager. Good to have you here with us this morning. Where are you seeing opportunity in mid-caps right now?
Good morning, Brad. Thank you for having me on. Yes, a mid-cap, I think is really a hidden gem, has the best of both worlds compared to small cap, and large cap, has a discovery value similar to small cap. It's still not very well covered by the street and very inefficient, but it also has similar financial quality compared to large cap and similar liquidity. So it really makes it a very fertile ground for active management. And I still think, I think investors typically are still under allocated in the mid cap space.
How are you evaluating small and mid caps amid what we're watching play out in the bond market, knowing that they're more dependent on the fluctuations in the cost of capital?
Well, some of them do. You're absolutely right. But, at Alger, we're stock pickers. So really, we focus on bottom-up analysis. And really, we favor companies that has very strong balance sheet and very strong cash flow generating capabilities so they can fund their own growth.
Okay, so as you're picking names, who are those names that rise to the top of the list?
Well, one of our high conviction names also been a long-term shareholder. We've invested in RBC Barron's since 2020. It's at Alger, as stock pickers, we invested in exceptional small mid-cap companies that have the potential to become exceptional large companies. And RBC really exemplify all the characteristics we look for in a exceptional company. The company, it's a market leader in highly engineered precision bearings for commercial aerospace, defense, and industrial markets. Those are very, mission critical bearings, are highly regulated and require very stringent performance requirements. And those are really, very critically important to manufacture and operations of, aircraft, mechanical system, and they reduce wear and tear, energy loss, and facilitate, power transmission, control pressure and flow. So it's a very special the company also has very special company, but they also have the best breadth and the depth of a company and very diversified in their markets. but also has, they are vast majority of their products are solely sourced, so it's very hard to replace them. That gives them a very strong competitive moat. So in today's world, people worry about, inflation and the recession, and we always say we want to invest in like a moldable, like, RBC. They have their own idiosyncratic drivers, their pricing power. Specifically, notably, the biggest, the fastest growing segment is commercial aerospace, which, we think it has a very strong tailwind for multi-year cyclical recovery. Number one is because, that industry saw a very steep downturn in 2020 and 21 due to COVID travel restrictions, but also, with the additional headwind, including the grounding of Boeing 737 MAX, and industry-wide supply chain constraints. But all those issues are resolved now. So we think, RBC is very well positioned to benefit from the multi-year, probably 10 plus year of cyclical recovery.
What should investors be keeping tabs on with regard to tariff policy as it flows through to small and mid-cap names that you're tracking?
That's an excellent question. I think we should focus on company can control their own destiny, like RBC Bearings, because you want a company have differentiated products, that pricing power, so they can pass, because their products are so mission critical, they can pass, most of their tariff, if some of all of them, right, to their customers. So I think, that's why we really focus on company have very strong competitive advantage and that have pricing power.
Amy, good to see you. Thanks for joining us again.
Yeah, thank you for having me.
Now time for some of today's trending tickers. We are watching Talon Energy and Urban Outfitters. Joining me now, we've got Yahoo Finance senior reporter Alexandra Canal. Ali, let's first go to Talon Energy and set the stage there. Talon Energy shares, they are rising as the company expands its nuclear energy pact with Amazon. The energy company provides carbon-free energy to Amazon Web Services data centers. There you're taking a look at Talon Energy shares catching a bid to the tune of about 6.8% right now.
Yeah, Brad, and per this deal, Talon Energy will supply nearly 2,000 megawatts of electricity to AWS data centers. So the long-term agreement runs through 2042. So it's a big upside benefit for both sides. One, it helps Talon secure steady long-term revenue. And two, it helps Amazon meet those carbon-free energy goals on the heels of that booming AI and cloud infrastructure demand. And to that point, U.S. electricity demand is rising for the first time in 20 years, largely driven by data centers and AI growth. We've seen similar deals within the industry. Constellation Energy and Meta, for example, inked a deal that will extend the life of a nuclear reactor in Illinois by 20 years. And investors clearly liking what they see. Talon Energy is up 7%, as you mentioned, and we're seeing it trade near the high end of its 52-week range as well.
Yeah, long-term steady source of revenue they're anticipating to come in from this deal here. We're going to be watching that. Plus, a good Philadelphia-based company here that we got on the agenda, Urban Outfitters, getting an upgrade to outperform from neutral at Baird. The firm citing Urban's strong long-term growth plan, especially with the strength of its rental service newly here. Shares of Urban Outfitters, URBN, up by about 1.8% right now.
Yeah, go Birds here, Brad. And
yeah, big go Birds territory trade.
Big go Birds territory. Besides the rating increase, we also saw a price target raise to $90 a share from the prior $75. This implies potential upside of about 30% based on where we're at today. Although this is on the high end of analyst estimates, we've seen over the past month a few Wall Street strategists turn bullish on this stock. Outside of Baird, Jefferies upgraded to hold from underperform, JP Morgan upgraded to overweight from neutral, and then we also saw Wells Fargo maintain its equal weight rating on those shares. And when we compile all of the analysts that Bloomberg tracks, we have 6 buys, 7 holds, and 1 sell. And you mentioned newly there, and that's been a great tailwind for Urban. I have several friends who use it for work, for play, for weddings. They're a big fan. It's a competitor to rent their runway, and it's really just another lever that this company can pull, especially when you have tariffs in the background. We had the CPI print from this morning. We are not seeing quite an impact yet on apparel, although clothing is one of the biggest categories that remain at risk. for potential price increases. And economists who I've been speaking with have said we probably won't see increases until June or July. So potentially more pain ahead there. For now, it seems to be okay. But for a company like Urban that does have clothing within their inventory, that is a risk.
Perhaps some of the same themes that play within that division newly within Urban that we were hearing about from the Rent the Runway CEO, Jennifer Hyman, last week. If you haven't seen that interview, you should go check it out. Great to have her in studio with us. Great to have you here in studio with us.
Thank you,
well,
Brad.
Ali. Thank you. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Well, coming up, we break down how prices changed in the food and shelter sectors according to the latest inflation print. That is next on Wealth. Shelter inflation rose 0.3% in May, remaining stubborn even as inflation largely slowed in the past month, with just a 0.1% increase. Year over year, housing costs rising 3.9% compared to 2.4% for the full index. Here to break down the latest report, we've got Yahoo Finance senior housing reporter Claire Boston. Claire, just take me into how you're reading through these figures.
Yeah, Brad. So once again, we have this world where shelter is really the main driver of inflation these days in what was otherwise a fairly benign report. So what I'm looking at is owner's equivalent rent. That is basically the homeowner's housing cost. That was up 0.3 of a percentage point, and then rents grew 0.2 of a percentage point month over month. And you can really see the impact of these higher housing costs when you look at that year over year figure. As you mentioned, across the board, prices are up 2.4%, but then shelter is up 3.9%. The only place that we really saw any relief in May was in that away from home housing. So that's your hotels, your Airbnb, and that was down by about 0.1 of a point. So, really no good news here. If you are a renter or a homeowner, your costs are still going up.
We also got the latest mortgage application data this morning. How is housing demand holding up right now?
Yeah, it's super interesting because housing is still really expensive, but we are starting to see mortgage applications improve a little bit. They were up 12.5% across the board this week. That includes both refis and purchases. Purchases were up about 10% and refis were up 15%. And what I think is interesting here is mortgage rates have been holding pretty steady. So what we think is going on here is just, some buyers finally responding to the fact that we have more inventory on the market. They have more to choose from. It's that peak summer home buying season. We'll have to see if this holds, though.
And finally, this one hit the inbox, too. A recent report from Point2 Homes found that renters actually outnumber owners in an increasing number of suburbs here. What's behind this trend?
Yeah, they found, I think, 203 metro areas where there are now more suburban renters versus homeowners. And a lot of what is going on here is this really tough buy versus rent math. With those 7% mortgage rates, a lot of people are looking at what they can afford to buy versus what they can afford to rent, seeing they could rent a much bigger house, and they're going that way. And, we often think of renters as kind of those city people, and then you buy and you move to the suburbs. But people are looking at that number and they're saying, hey, you know what? I'm going to move to the suburbs. I want that extra space, but I'll keep renting. And when you look at where this is happening, it's a lot in the Sunbelt markets, those cities in Texas, places where builders have been really active. And builders have actually just been building homes now with the intent of renting them out to those consumers.
Claire, great to have you here with us today.
Thank you.
Food prices rising in May from the month prior, according to the latest inflation print from the Bureau of Labor Statistics, known in your hood as the BLS. Groceries, or the Food at Home Index, showed prices increased 0.3% last month. We saw that monthly figure fall 0.4% in April. Here with more, we've got Stu Leonard Jr., CEO and president of Stu Leonard. Stu, always a pleasure to grab some time with you. Just first and foremost, take us into the areas, the parts of folks' shopping carts that you're seeing the most moderation or customers push back.
Well, right now we're a family business here up in the Northeast. We have 8 stores. We have 100,000 customers a week. And we pride ourselves in being on the floor and keeping our ears open to what customers say. So far, people feel pretty confident. At least at our company, we have not raised prices yet because of the tariffs or anything. Prices are the same right now. But you know what? There's a supply and demand issue right now. Like I was talking to our ranchers out west. The herd size in America is the lowest that it's been in like 40, 50 years right now. So that's a supply and demand issue. So I think you have to break apart a little bit of any increase in costs. It's not tariffs. A lot of it is due to supply and demand also.
And that's so interesting to hear, the herd issues that you were mentioning a moment ago. That comes after the avian flu hit, of course, a lot of the egg and bird and chicken prices that we had seen as well. So I wonder how much lag is there until there's typically some type of pass-through in prices that consumers have to wade through?
Well, Brad, one of the things that we deal with a lot of small local businesses, and a lot of them are getting hit with the tariffs. I made a little chart together for you right now.
Oh, wow.
Which is right here. Okay. So take a look at this. You see this right here? Can you see this thing?
We do. We got it loud. You don't have to adjust anything, Stu. We got you.
Okay. You got it? Okay, good. But basically, this is the tariffed items over here that we're seeing problems. Bananas come from Costa Rica. Pineapples, Costa Rica or Peru again. We have wines and champagne and from Europe right now. Those are all tariffed. So a lot of these are small suppliers. I mean, obviously bananas isn't that big. We've gotten a 10% increase in tariff. We've split it with the importer. So we're eating 5%. Our family is eating 5%. These are the items that keep us alive over here. We have avocados. There's no tariff on them. Salmon, there's no tariff. You have beef right now, which is non-tariff, but as I said, it's bumped up a little bit because of their herd sizes. And lobsters here, we used to ship, I think the United States shipped 80 million pounds a year to China. And with those high tariffs, we're getting the benefit in the United States of ample supply of lobsters. The price has gone down a little bit. Same with grapes right now out in California. We brought them onto our soil in the United States. And the same thing, it has to do with melons. They're throwing them down in Georgia right now, which are beautiful.
Yeah.
So it's a good time for us because the local produce and the local fruits and vegetables are coming online. I can't do anything about pineapples and bananas because we don't deal with them in the United States.
Yeah, and we know that we don't have the amount of tropical regions necessary to grow out the type of supply that would be necessary to really support and sustain the type of demand here in the U.S. alone, so that a lot of those are imported. I wonder, Stu, while we have you, as we're thinking about some of the recalls that have also come forward within the food and beverage industry, how is that kind of passing through to inventory and where customers are being selective after they hear about some of the food recalls?
Well, food recalls you can't control. I know there's an egg situation going on out in California. It doesn't affect us on the East Coast here at all. But hey, you know what? When you get a recall, you got to clear the shelves and notify your customers. You can't predict them. You just have to react very quick to a recall.
What are some tips that you have for customers, whether they're shopping at Stu Leonard's or whether they're going to some of the other great grocery stores around the nation? How can they save over the summer?
Well, one thing I can tell you, we don't want to raise prices, okay? Because if you go from like even $4.99 to $5.09 or $5, sales go down. Our suppliers know that too. So we don't want to raise prices right now. The best thing you can do is we're still getting deals from people. And so check the specials out. Go look at the apps. Look at the emails that you get from customers. We have we got hot dogs, buy one, get one free for 4th of July coming up. There's always those deals, so you can save that way. The second thing I would urge you to do is test out and try private labels. Some of them are made by the same manufacturers as the name brand, but you can save maybe 20% on those things. And, take advantage of some of these app deals that customers have laying out there. And you know what, Brad? The one thing I would say, we do like 10 demos a day at Stu Leonard's. We're sampling chicken salad. We're sampling it. And don't go over to those demos because sales usually double or triple when you demo an item. Look what Costco does, when you go in there. So walk by the demos, okay? Don't throw that one extra item in your cart. Overall right now, I feel just being here on the store floor with all these customers around, talking to our suppliers, they're all feeling pressure from increased fuel prices, from increased labor prices, energy prices. You know, we're doing the same in our business. Those are all costs they're trying to, hold on to.
Yeah.
And then our customers, though, feel pretty good. I think the mood's pretty good out there right now.
Interesting.
We've been having brisk sales, and we're going to feel a little bit. We're in a low margin business. We're going to feel a little bit of a squeeze this year because of the tariffs. Because we're going to keep those local small farmers in business, okay? And we're not. Yeah. I'm not going to use my big buying power to squeeze those guys too much.
Stu, we appreciate that, and we know you have a lot of buying power. Are you about to show us the lobster? We know you had a lobster standing by.
Are
wow,
you
okay,
a dad,
that's the tomahawk.
Are you a dad?
I am not.
Okay, this is for 4th of July, for Father's Day, okay, coming up. Get Dad one of these babies. Am I frozen on there or not?
You're not frozen.
Okay, good. The other thing, try Dad with a lobster, okay? Get him a nice lobster. And then, a lot of times, and my wife's like this here, but here you could go with one of these big guys like that. How do you like that thing? Huh?
I mean, you're just gripping it up by the gill. Look, yeah. It's a great looking fish, good looking lobster, and a great looking tomahawk as well. I guess I'll just have to accept the role of cat dad going into Father's Day so I can get one of the three. Stu, thank you for taking the time.
Hey, happy Father's Day to Dad. Brad, if I could just mention, it's drowning season right now. My wife and I lost a little boy to a drowning 30 years ago. I please, all the people watching, all the moms and dads, watch those little kids around the pool and ideally get them into swimming lessons. 4 lessons of waterproof. Okay, so be safe this summer. Drownings are going to skyrocket right now in June, July, and August. So be really vigilant around the water.
That's great advice, and thank you for sharing your story. We appreciate your time as always, and thanks so much for giving us the pulse on consumers. Stu Leonard Jr.
All right. Thanks. Bye-bye.
Coming up, advice for new graduates on making their first investments. That's next on Wealth. We are about 2 hours into trading here on the day. Let's get a check of the markets as we're taking a look at the S&P 500. We're holding on to gains right now of about 0.2%. I want to put this on an intraday chart for you just so you could see how we've been maneuvering what has been a CPI print today, what has also been a tariff agreement day. We're still waiting on full sign-off from both President Trump and President Xi Jinping of China. But as we're taking a look at how the markets are digesting all of this, still fractional gains for the S&P 500, still fractional gains for the NASDAQ 100, and then additionally, the Dow Jones Industrial Average, you guessed it, still fractional gains. We did touch negative territory, but we are now solidly in positive territory, at least as of right now. We're taking a look at some of the 11 S&P 500 sectors here. We heard you like heat maps, so we got you some green and red on the screen. As we're taking a look at 2 of the laggards here on the day, materials and staples pulling up the caboose, fractional declines as they may be, materials down by about 0.5%. And then you've got to look at technology right now. That's up by about 0.4%, leading the sector activity here. It looks like we've got about 9 out of the 11 S&P 500 sectors in positive territory right now. I want to quickly toggle on over to the NASDAQ 100, give you a look at the technology landscape, blinding you with science as of right now, taking a look at the equal view so we can get a good gauge on where we fall, and it looks like we're just about split, almost. As of right now, pulling up the caboose, Intel, that's down by about 5%. However, continuing its run that we've seen over the course of 2025. Let me just put this on a year-to-date view for you folks at home. I know it's one of the consistent top trending tickers on the Yahoo Finance platform. It's PLTR, baby. It's Palantir. Take a look at that. It's up by about 81% year to date. Adding on to those gains here today, it's up by about 3.3%. And then just lastly, I'll take a look at the Dow components. 30 components fired up here for you on the screen. Looks like we've got a good bit of red here. Cisco is the deepest of the decliners. However, 3M leading the pack. It's up 1.7%. New graduates are entering into one of the toughest job markets in recent history, with unemployment rates for recent grads hitting 5.8% compared to just 4% for all workers. So it's a crucial time for young people to make smart financial moves. I want to bring in Dina Healy, who is the Ameriprise Financial Vice President of Financial Planning and Advice. Great to have you here in studio with us. You have 4 pillars of advice for new graduates. Study your benefits, establish a strong credit history, develop a budget, and take advantage of uncertainty. So let's start with benefits. Why is it important to study those benefits?
It's an exciting time for new graduates into the workforce to think about what benefits they have. It's a great time to take a look at what's offered, whether they have a 401k. This may be the first time that they've had access to a 401k. So making sure that they can max out at least the employer match, but also looking at health insurance. This is probably the first time they've had to pay for health insurance. And then what are the other benefits available to new grads into the workforce, and taking advantage of what's offered to them.
So why is it also important to establish a credit history? And I mean, this is really going to set folks up for life, basically.
It absolutely will. It will set the foundation. You think about your credit history, and whether you're renting an apartment for the first time, whether you're buying a car, you're buying a house, all of those things will look at your credit history to determine whether you're a worthy risk. And so if new grads, new folks into the workforce can manage to live within their means, making sure that they understand what their expenses are, and then if they can start to think about, can they get a credit card to start to establish that credit history, making sure that they don't overcharge on that card and pay off the balances every month. That'll put them in a really solid foundation for future financial decisions that they may make.
Yeah, it's great advice. Also here, we know that you've got to develop a good budget, even if your funds are limited. So how can you go about really setting the foundation there?
Yeah, I think first it's important to understand what you have to work with. What's your income? What are your expenses? I think the areas where you can run amok a little bit are eating out and spending a lot of money on going to restaurants or bars, and just focusing in on how much can you afford on a monthly basis for some of those extras, and trying to live within your means. That'll be super helpful.
Now, young investors, how can they take advantage of uncertainty? I mean, there's been plenty of that permeating and really rattling around over the course of 2025 in the first half of this year.
Absolutely. If I were a new graduate, while obviously the job market may be challenging, the volatility in the market uncertainty can play in their favor. They have a long time to invest. And so when I think about saving into a 401k or saving into the stock market, you're actually having the opportunity to dollar cost average. That means buying in over time. And if the market is down, you're buying things on sale essentially. So if you were to go to Target and buy laundry detergent and it's on sale 2 for 1, you're going to buy 2 because it's cheaper, right? The same thing is happening with the stock market. If you're new into the market, you have plenty of time. This is, to me, exciting for you because you're buying in at potentially lower prices that long-term, you'll see that long-term appreciation.
I'm going to ask you a bonus one here, especially as we have even more of a mindset among younger folks, new graduates who are looking across the gig economy, the influencer economy, and looking at the job market as well and trying to say, okay, if I can't get into the job market right now, how do I start my own business and generate my own income? What is the best way that they can set a foundation for generating different streams of income as well over their careers?
I think that's a great question. And certainly owning a business is a way to generate wealth. What I would say is making sure you have good personal financial fundamentals, having a savings account, building up a cash reserve, understanding your expenses, understanding tax implications. All of those things will help you if you're thinking about starting a business, making sure you have some sort of foundation to protect the downside in the event that things don't go as planned.
Great advice. Tina, thanks so much for taking the time here with us.
Thank you. Appreciate it.
Coming up, everyone, we get to the latest news on how President Trump's policies impact student loan borrowers. That's next on Well. All week, we're giving you everything that you need to know about paying back your student loans. And today, we're breaking down all of the latest policy changes under the Trump administration. Joining us now for that, we've got Mark Kantrowitz, author and student loan expert. Mark, let's start with some of the proposals in the Republican budget bill. What changes could come for borrowers if it is passed as is?
Well, first of all, it repeals the subsidized Stafford loan for undergraduate students and the Grad Plus loans for graduate students. It sets, the House version of the bill sets new aggregate loan limits of $50,000 for undergraduate students, $100,000 for graduate students, and $150,000 for professional school students. The Senate version of the bill, which just dropped this morning, has $200,000 limit for professional school students. And it has an annual limit for the undergraduate students for the grad Stafford loan of $20,500 and $50,000 for professional school students. It gets rid of the economic hardship deferment and unemployment deferment, and changes forbearances to 9 months out of every 24 months. And it replaces the dozen or so student loan repayment plans with just two: a standard repayment plan, which is more like an extended repayment plan. The repayment term depends on the amount you owe, and an income-based repayment assistance plan, which is an income-driven repayment plan that has monthly payments that are slightly less than the current income-based repayment, but much higher than under the SAFE repayment plan, which has been blocked by the courts.
And so, as we're trying to think about some of the largest changes for what this means longer term, are students going to end up having a more difficult time getting student loans, not just applied for, but also getting those disbursements as well? What's the net effect?
Well, the net effect is that students at higher cost colleges that need to borrow more are going to have to borrow from the private student loan programs, not just from the federal student loan programs. So about 7% of undergraduate students, up to a little bit more than half of medical school students, will have to borrow private loans because the federal loan limits will not be enough. The grants are also going down, which may shift some students from getting grants into borrowing or not going to college at all. The House bill eliminates Pell Grant eligibility for students who are enrolled less than half time. And that's going to disproportionately affect students at community colleges. It also changes the definition of full-time from 12 credits a semester to 15 credits a semester, which is the equivalent of about a 20% cut in the Pell Grants that the students who were previously enrolled in 12 credits will receive. That means they're going to have to borrow or not go to college at all.
And so with this in mind, Mark, we're getting some breaking news that's coming across this morning as well, as the New York Times is reporting the Fulbright board is resigning after accusing the Trump aides of political interference. What's the significance of this board resigning from their post and the type of interference that they're alleging?
So the Fulbright program is an international student exchange program. U.S. students go overseas, and international students come to the U.S. on the Fulbright scholarships, which is an extremely prestigious program. And the President Trump has announced some changes, some significant changes in the program, including cuts to funding and changes to eligibility criteria. And the board, which is involved in the design of the program and the selection of recipients, objected to this, and their reaction was to resign from the board, and the entire board just resigned.
This comes after we had just seen President Trump tout the U.S. and China negotiations, which also, to some extent, targeted or made sure that there was the availability for an opportunity for more Chinese students, Chinese-born students or residents, to be able to come to U.S. universities, which we know has long been intact. It's only as of recent that there has been some of the demand that has sputtered elsewhere because of the geopolitical tensions between the two entities. Is there any significance to now the negotiations netting out and ultimately what's come forth on the U.S. and China university front?
Well, besides the Fulbright program, international students arrive in the U.S. through all sorts of other programs or just independently. They are a revenue center for U.S. colleges since they do not qualify for most institutional financial aid. So they are considered full-pay students. And there's data that shows that students from China are the leading source, followed by India and a few other countries, UK as well. and the decline in enrollment in U.S. colleges and universities of international students will have a major deleterious effect on the funding of those universities. And we're not talking so much about the elites as a lot of other colleges like NYU and such depend significantly on international students.
Mark, it's always a pleasure to grab some of your insights. Thanks so much for taking the time, breaking down the latest, of course, that could be coming forward from the bill, as well as this breaking news. Thank you.
You're welcome.
Coming up, we dive into Chewy's latest earnings report with the company's CEO. That's next on Wealth. We're tracking an earnings mover this morning, online pet retailer Chewy. Yahoo Finance executive editor Brian Sozzi is here with me now.
All right, thanks so much, Brad. Shares of Chewy moving lower, failing to meet what analysts are calling a high bar on guidance. That reaction, despite beating on the top and bottom lines in the first quarter. We're joined now by Chewy CEO Sumit Singh. Sumit, good to see you. It's been a while. Definitely going to touch upon earnings, but really the story of this morning has been what looks to be some form of framework with China on trade. Now, you're a retailer. You source some hard goods from China. As the CEO of a company like that, does it make you feel more confident in your outlook for this year?
Hey, Brian, nice to be here. Nice to see you also. So, Brian, I think it's important to remember that for Chewy, about 85% of our sales comes from repeatable, non-discretionary categories like consumables and healthcare. I think an additional data point that is super supportive of our revenue flywheel is the fact that 82% of our net sales this quarter came from our quasi subscription product called AutoShip. And so if you put the two data points together, what that says is that our exposure to a non-discretionary, and as a subset of that, China is lower, much lower compared to perhaps the rest of the industry. And so in that way, it puts us in a relatively well-insulated position to handle the year. And we're using the strong balance sheet that we have to be able to obviously position ourselves to mitigate any sort of material impact, on the income statement. And so we feel very good coming out of Q1, having delivered the results that we just have, growing 2 times the market, and super bullish about what the rest of the year has for us.
But Sumit, a lot of retail executives or CEOs that I talk to, they've spent a good chunk of their year figuring out ways to dismantle supply chains in China that have been there, in some cases, decades. Have you had to do that with your team? And if so, where have you moved product to?
Yeah, I think the revenue composition of the business matters a lot, right? So that's the first point that I'm making, that in our case, the composition of the revenue, it puts us in a position of, perhaps better insulation. Number 2, the quality and, the expanse of the supply chain matters a lot. So, through the pandemic, look, you've known Chewy for a long time. We've grown from a less than $2 billion retailer in 2017 to an over $12 billion retailer, 7 years later. And so when a company grows that quickly, that fast, you have to rebuild your supply chains along the way. And, I'm very proud to say that we have a very high quality team and a sophisticated supply chain and operations network that is very well connected internationally, domestically, and provides us the opportunity to be able to react. So not only are we long-term focused, but our ability to react in the short term is also really good. So we kind of, in anticipation of the way the supply chains are going to react, we've essentially made the changes that we had to make in inventory buying, inventory placement, so that from a customer impact point of view and from a P&L point of view, we are able to insulate and sort of minimize that disruption. So I think those are the 2 points that I would focus on for the most part.
Sumit, Brad here, and great to have you on the program with us. As you think about the growth that's offsetting some of the churn, which is improving, as you were mentioning on the call as well, I wonder what you're seeing in the average purchasing strength across some of those newer customers, knowing where they're pushing back on prices elsewhere for household goods or services.
Yeah, it's a very good point. So first of all, look at the revenue composition in terms of customer algorithm. So our revenue of 8%, 8.3% to be specific, was driven by a combination of net adds increasing about half of that, and then the other half was covered by share of wallet increase. And so, and pricing, right, or inflation is relatively non-existent in the system in Q1. So first of all, the composition of revenue growth is all structural and fundamentals. Number two, when you compare the Q1 cohort for 25, so let's say new customers or gross additions that we brought onto the platform, so we're measuring their quality in terms of two core metrics. A, the amount of NSPAC or net sales per active customer on the platform, and two, also driven by their reorder rates, right? So both are important. So get the customer that is higher quality and then see if you can sustain the ordering rate. On both these metrics, we're seeing, low single digit higher performance from the cohorts that we're picking up now on a year-over-year basis. That gives us the confidence that this consumer, right, isn't really trading down. This is a higher quality consumer being picked up in repeatable categories, and therefore should sustain kind of forward demand momentum.
Sumit, we're watching the, of course, stock, it's getting hit on these results. Now, you reaffirmed your full-year margin outlook, but on the conference call, you mentioned that the first quarter may represent the high mark for the business, may see some sequential declines. How has the business started in the second quarter, and have you seen a more cautious consumer given everything going on in the economy?
We haven't at Chewy. We're, the momentum that we've carried out of Q1 actually has continued. In fact, it's just the shape of the curve. So the first quarter, at 6.2% EBITDA margins, for the first time, company crossed the 6% mark. So we're very happy very proud about that. And then broadly, we've guided to a midpoint of, roughly 5.5% EBITDA margins for this year. That would put us at about a 75 basis point expansion from a year-over-year perspective. Plus, for Q2 sequentially, we've guided, a higher gross margin rate as well. So regardless of how you piece apart the income statement, our ability to deliver both growth as well as deliver profitability, and we're going to convert 80% of that profitability into free cash flow. Because if you analyze our balance sheet, we're essentially guiding roughly, plus $550 million of free cash flow at the midpoint.
Right.
And so, all of these are super encouraging metrics for investors to consume and for us to execute around.
Sumit, great to have you here on the program with us. Chewy CEO Sumit Singh and our very own executive editor, Brian Sozzi. Thank you.
Take care, guys. Thank you.
That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination coming up at 3 p.m. Eastern Time. They'll count you down to and through the market close.